So if I'm lending an individual money for a real estate deal, how are they getting the money to pay me back?
Yeah, so there are a couple different ways to get the money to pay you back, but the number one way in these fix and flips instances is that they are selling the property. So they bought the property for 65,000. It was as is value of 100,000. It had an after repair value of, let's say, 400,000, and they put 100,000 of their own money into fixing it and flipping it themselves, right? They put a new roof on. They updated the HVAC. They redid the plumbing. Redid the flooring, painted the walls, redid the kitchen. All those things they put in 100,000. So now they have the 100,000 that they put in. They have the 65 that you put in, so 165,000, and they're selling the property for 400,000. So then they have a really sizable profit right there, right? Now, of course, they have to pay title. They have to pay the real estate agent. So it's not that, it doesn't mean that they get the 400 minus 165 and that's their profit, but you can still tell there's a nice chunk of change in there that they'll make their own profit, so that they'll have money then to take to the next deal on their own for the rehab, and then they'll also have the money to pay you out your interest.
So then what happens if the house doesn't sell?
So there's a couple of options if the house doesn't sell. So first thing is that they could do a refinance, and this is part of the BRRRR strategy. So it's buy, rehab, renovate, refinance, repeat, rent, refinance, repeat. Yes. Okay, so buy, rehab, rent, refinance, repeat. So basically, the process is that they're getting a renter in there so that that renter is justifying a new mortgage. So taking away that big 12% or whatever that they were, paying you. And now they're getting into a more traditional monthly payment, right? So that's more of like the 7% interest that we're seeing these days. Maybe they can get down to 6%, something like that. But that new mortgage will pay your loan off entirely, and that's when you get your money back and the additional interest if it was pay at the end, or the last month of interest if it was a monthly payment sort of situation. But that's how you get paid back if the property doesn't sell. The other way is if, let's say, that they can't refinance you outright. The as is value was 100,000. They put in 60. As this value is 100,000, you loan them 65,000. They put in 100,000. They thought that it was going to go for 400,000. And every week they're dropping the price another 5,000. And now all of a sudden they're somehow at 165,000. So clearly all the money doesn't come out. So they may have to pay you back from another deal or their own personal funds at that point in time. But because you loaned at the as is value and not the after repair value, your money is still very secure.
So it sounds like it makes sense to not loan the full amount that someone asks for most of the time. Is that correct?
Most of the time, that is correct. You could potentially be a little bit more liberal with the amount as you've worked with this person over and over and over and over again. They have a track record of payback, but you still wouldn't be loaning 100% of the as is value, even with that track record. You could maybe say, instead of doing 65,000, you could do 70,000, you could do 75,000, but you wouldn't be going to 95,000 as an example.